Can you guys hear me okay? Apologies for the construction in the background. Why don't we, let's kick off. So actually, for those of you who are here now, it was a lot hotter last night when we did our rehearsal, so it's not too bad. So I'll kick off with a review of our operations and of the business, and then Dan will come back, look at the financials, and then I'll close with a session on the strategy. So our EBITDA in the first half of the year was not as strong as we would have liked. That being said, there are clear reasons for that, specifically 2 unplanned outages at the power station. Beyond those issues, the business has been performing well. Our pellet business almost doubled its production. The power station had a strong second quarter, and our B2B energy supply business has grown its customer meters by 9% year on year. Power markets have been stronger, allowing us to sell a portion of our future generation at higher prices. In the second half of the year, we expect this improved performance to continue. Our pellet business should continue to grow production and earnings, as should our B2B energy supply business. Margins should be higher at the power station. We will have the benefits of the Unit 4 biomass conversion and also of higher capacity payments on our coal units. For all these reasons, our expectations for full-year earnings remain unchanged. The board's confidence in the future earnings and cash flow of the business is strong. Today, we are announcing an interim dividend of £22 million and expect to declare a full-year dividend for the full year 2018 of £56 million. At Drax, we're committed to delivering strong operational and financial performance and sustainable returns for shareholders. We also believe that the changes we are seeing in the UK power system are creating attractive opportunities for us to invest and to do more. As we go through the presentation, I'll be highlighting those opportunities. Safety and sustainability are at the core of what we do. We work in challenging environments. Both coal and biomass must be handled carefully, or they can pose significant safety risks. We have talked about the small fire we had in December. Over the course of the first half, we have completed an exhaustive review to understand the root causes of the incident. The first key point is that the equipment, systems, and processes we have in place are fundamentally sound. At the same time, there is always more that we can do, so we're continuing to invest in enhancements to our equipment and processes to reduce the risk of the event reoccurring. The second issue we had in February was a more traditional generator fault not related to biomass, and this has now been resolved. Overall, our safety record continues to be strong and in line with prior years. The biomass that we use must be sourced sustainably to ensure that it delivers the appropriate level of CO2 reduction, while at the same time we support the habitats in which we operate. We continue to deliver on our commitments to sustainable biomass. Finally, it's worth noting that the EU has adopted RED II, an update of the Renewable Energy Directive, and we are pleased that the policies it has implemented are in line with best practice and the way that we operate. Drax Biomass has delivered an excellent performance. We earned $10 million of EBITDA for the half year, a $14 million increase on the first half of 2017. We increased our production by 80% to almost 700,000 tons. Our nameplate capacity is about 1.5 million tons, so we're getting close to that. This is both due to excellent performance at Monroe and Amite, the 2 plants that we've built ourselves, but also due to LaSalle, the plant we purchased last year, coming on stream ahead of plan. We are reducing costs, and that is DBI's #1 strategic imperative, so that we can make biomass viable without subsidy. Increased volume plays an important role as we spread fixed cost over a larger base. We're also seeing the benefits of our dry shavings investments, which allow us to use cheaper feedstock. We have streamlined our operations by moving our headquarters from Atlanta to Monroe. We will continue to develop projects to expand our capacity at our own sites. Those projects have excellent returns and have the added benefit of reducing our pellet production cost. We will also look opportunistically at acquisitions. As I have mentioned, the first half was challenging for Drax Power, given the two significant unplanned outages. That being said, the team has responded well and has a strong platform for delivering our full-year plan. If we can deliver availability in line with our history, we should be in a good position to do that, given the improvements both in the market and in our overall business that I have just been through. We continue to be the UK's largest single source of renewable energy, generating 6.3 terawatt hours in the first half. Coal has become increasingly uneconomic in spite of the increase in power prices. Carbon prices have also increased substantially, as you know. As a result, only 6% of our revenue in the first half came from coal-fired power sales. Our earnings from system support and flexibility were down in the first half by £12 million. This is because our Black Start contract this year has significantly lower value than the year before. Longer term, we continue to see a significant and growing opportunity to deliver returns through system support and flexibility. Our strategic projects, the Unit 4 conversion, the repowering, and the open cycles, are all proceeding well. Our B2B energy supply business continues to perform well, with EBITDA increasing to £16 million from £11 million in the prior year, in line with our plans. We have delivered this while absorbing the costs associated with a more challenging business environment for our customers, both as a result of a more difficult economy and also Brexit, but also due to the structural changes arising from more shopping online and the resulting impact on the high street. As a result, the bad debt charge was higher than in prior years. We also experienced significantly higher gas consumption when gas availability was tight during the so-called Beast from the East weather system. That also hurt our earnings. But more fundamentally, we continue to grow. We increased meter points year on year by over 9% to almost 390,000. Our renewable energy proposition is doing well, as almost 60% of our sales are now renewable. We're in the process of implementing a new IT platform. The first piece of that went live at Haven in the first half of the year, a new finance and procurement system. We are rolling the full system out progressively through Haven and subsequently Opus. It will enable us to continue scaling the business and offering innovative solutions to customers in a smart meter world. Finally, we are seeing growing interest from our larger I&C customers for energy services. This is starting with demand-side response, which we can help them provide to the grid. Our approach to this market will be very much customer-led, and we are starting to create the capability to provide the solutions that customers are looking for. Now let me turn it over to Den.
And good morning, everyone. Will has given you a good summary of the group's performance, and I'll now go through the numbers. Financial highlights. EBITDA of 102 million was lower versus the first half of 2017. I'll come on to the detail of this shortly, but this principally reflects two specific outages in the generation business, offset by growth in pellet production and the B2B energy supply. Notwithstanding these outages, I would note that our expectations for the full year remain unchanged. The board has declared an interim dividend of 5.6 pence per share. This is equivalent to £22.4 million. a 12% increase on the first half of 2017. And we expect to pay an ordinary dividend of 56 million for the full year. This is a level which is sustainable through the business cycle and which we expect to continue to increase as the strategy delivers higher levels of EBITDA and cash in the future. We have also made progress with the previously announced 50 million share buyback program. At the end of June, we had purchased 4 million shares at a cost of 13 million and remain on track to complete the program ahead of the 2018 full year results. Cash generation has remained strong, and with 112 million of net cash from operating activities, alongside strong cash management and investment discipline, this leads to the continuation of an operating cash conversion rate of over 60%. To support the strategy, we also completed a refinancing of our floating rate debt, replacing it with long-dated fixed rate bonds, which will provide greater certainty over interest payments and an extended maturity profile and an attractive all-in interest rate. Our balance sheet is in a strong position with cash in hand of 245 million and net debt of 366 million, a slight reduction from December 2017. Underlying earnings of 1.6 pence per share reflect lower generation earnings. Moving on to the detail of the income statement. Revenue growth principally reflects the acquisition of Opus Energy and renewable support. I will come on to the components of EBITDA in the next slide, but below this figure, firstly, a charge of 84 million for depreciation and amortization, down 6 million year on year. This excludes a charge of 27 million in relation to coal-specific assets following commencement of work to convert a fourth biomass unit. Net finance costs of 16 million reflect interest charges on a high level of debt following refinancing and movement on foreign exchange balances. This figure excludes 7 million related to the refinancing of our floating rate high-yield bonds, which took place in April. Now, the small underlying tax credit includes the benefit of tax refunds claimed under the UK patent box regime. This will continue to reduce our headline corporation tax through to 2027. Taken together with a lower level of EBITDA, this leads to underlying profit after tax of 7 million, compared to 9 million in the first half of 2017. I'll come on to cash in more detail, but to summarise, the balance sheet is strong with net debt of 366 million. And this reflects healthy cash generation from our core operations and working capital inflows. Our operating cash conversion, excluding working capital improvements, has been over 65% for the last 2 years. And this will continue to increase as the energy supply and pellet production businesses contribute increasingly to EBITDA. Okay, I thought it would be helpful here to do a bridge from the first half of 2017 to the first half of 2018. This is the graph at the top of the slide here. I'll also give you a sense of the key drivers for the remainder of 2018, and these are the bullet points at the bottom of this slide. So if we go to the waterfall diagram at the top, power generation was lower due to 3 areas. Firstly, biomass generation, where we had 2 biomass outages in the first quarter. The first of these was a fire at our biomass rail unloading facilities at the end of 2017, which extended into January and restricted biomass operations on 2 ROC units. The second was a non-biomass related generator outage in February, again on one of the ROC units. Secondly, ancillary services, where we received a lower level of system support, which reflects a specific 1-year ancillary service agreement, the provision of Black Start services between April 2016 and March 2017. And lastly here, a reduction in coal operations reflecting the continued challenging market for coal operations in the UK. In the US, pellet production has been strong, increasing volumes of wood pellets produced and sold by 80%, driving revenue growth and EBITDA of 10 million versus a 4 million loss in the first half of 2017. Now, energy supply, now a meaningful and growing part of the group's earning profile, saw revenues increase from 0.9 billion to 1.1 billion and reported EBITDA of 16 million, in line with expectations. And this is inclusive of an increase in bad debt, reflecting more challenging operating environment for some customers and the impact of a tight gas supply during the exceptionally cold weather we experienced in the first quarter of this year. Now, central costs are reduced, and this reflects tight corporate cost management, consistent with a cost base of around 30 million for the full year. With regard to other, this is principally the elimination of intergroup balances related to biomass cargoes between the pellet production and generation businesses at the balance sheet dates. Now, moving to the bottom half of this slide and the outlook for the rest of 2018, where we expect generation to benefit from improved biomass availability versus the first half, stronger margins and optimized biomass generation with the commissioning of the 4th biomass unit, in addition to the start of T4 capacity payments for coal. Given the strong contracted position in place for power sales, we do not expect further value from the improved commodity environment in 2018, although this does provide a benefit in future years. In pellet production, we expect growing volumes of pellets from La Salle, savings from the reallocation of our offices in Monroe, and with a closer operational focus, the opportunity for further reductions in cost per tonne of pellets produced. Lastly, in B2B, we expect market share to increase while focusing on margin, which will be supported by the rollout of our new platform to serve customers. Now, these factors underpin our expectations for the full year, which remain unchanged. So to cash flow, an area where we remain strongly focused. Small improvement in working capital reflects a number of things. Firstly, a reduction in inventories due to the lower biomass operations in the first quarter of the year. Lower receivables due to seasonally low summer sales, and an increase in payables reflecting a new corporate procurement facility. Less increased ROCs held for sale, which is typically higher in the first half of the year, given the nature of the compliance period. Taking this together with EBITDA, debt service of 18 million and a tax credit of 7 million gives net cash from operating activities of 112 million. After acquisitions, refinancing, capital investment, which I'll come on to next, and an increase in dividend payments, we had cash on hand of 245 million at the half year, with net debt at 366 million. Moving on to investment, total asset additions in the first 6 months were 46 million, with our expectations for the full year remaining unchanged at 100 to 110 million. This includes 50 million of maintenance and 30 million associated with the development of the 4th biomass unit conversion. The balance being focused investment in improvement projects, which will support growth and deliver attractive returns. Just to give a few examples of these relate to enhancements to our generation assets, where we know that modest improvements to efficiency will deliver fast payback. Continued development of our B2B energy supply IT platform, which we expect to support growth and reduce our cost to serve customers. And as our part of our aim to reduce long-term biomass costs, we expect to invest $15 million in a rail spur at La Salle Bioenergy, allowing us to move pellets cargoes to our Baton Rouge export facility by rail rather than truck. Once operational, this investment will deliver operational efficiencies, a reduced carbon footprint, and economies of scale, leading to lower biomass costs and an attractive return on capital. More from Will on this shortly. And in pellet production, we continue to target a self-supply capacity of 30%, either organically or through acquisition. And to that end, we remain alert to sector opportunities. On financing, we have continued to enhance our access to capital. During May, we completed our already strong balance sheet with a successful refinancing of our 200 million floating rate notes with $300 million of fixed-rate notes, extending the maturity profile of our debt to November 2025, and providing protection from an increase in interest rates. When swapped back in sterling, the bonds offer us an attractive rate of interest of around 5%. At 30th of June, there are no amounts drawn on the central RCF. Now, these are all components of work we have done over the last few years to structure our business, financing and trading arrangements to operate successfully as a sub-investment grade entity. The bonds are rated BB+ by S&P and Fitch, a level we remain committed to and which is robust to low points in the cycle. As we have previously said, we remain focused on opportunities to optimize our balance sheet and the use of working capital across the group, which we believe is good discipline in driving returns on assets. We are committed to making disciplined capital allocation decisions, as well as driving operational excellence across the group. A strong balance sheet remains a priority, and we continue to define this as being net debt to EBITDA of around 2 times. We will continue to invest in our core businesses and to drive our strategy. The board has confirmed an interim dividend of 5.6 pence per share, as I previously said, and this is 40% of our expected full-year dividend of 56 million for 2018. Now, this represents a 12% increase on 2017. The growth in the level of the ordinary dividend is a measure of the board's confidence in the ability of the group to pay a sustainable and growing ordinary dividend as part of our strategy for growth, whilst delivering returns to shareholders. However, the precise level of growth will vary year to year, depending on the operating environment and investment needs of the business. If there is a build-up of capital in excess of the group's investment needs and balance sheet requirements, the board is committed to returning this to shareholders using the most appropriate mechanism. This informed our decision to initiate a 50 million share buyback programme and is a commitment from the board to deliver a strong balance sheet with investments in growth and returns to shareholders. So in summing up, EBITDA in the first half was lower due to specific outage issues, but with good operational performance, improved generation margins, and further growth across the group in the second half, our expectations for the full year remain unchanged. We have further strengthened our balance sheet with financial structures to support growth, and at the same time implemented opportunities to improve operations and profitability, reduce costs and CapEx, and optimize the use of working capital. Through these measures, we have put in place a framework to allow us to develop a strategy for flexible low-carbon growth aligned with the UK's energy needs, whilst delivering attractive returns to shareholders. And with that, I'll hand you back to Will.
Thank you, Dan. Okay, so let me just talk a little bit about delivering the strategy. So the UK is transforming to a low-carbon economy. Greenhouse gas emissions are down by 43% compared to 1990, but more needs to be done to achieve the government's target of 80% reduction by 2050. While much of that will be done in industry, transport, and heat, there is still more to be done in power. We expect that renewables and nuclear will be 75% of the UK's generation mix in the long term. They generated about 50% of the UK's power last year. The other 25% will still need to come from large-scale spinning plants, largely gas, but also biomass and other things like pumped storage. Coal will soon be off the system. This type of generation will earn significant returns not just in the energy market, but from the value of flexibility. And we see significant opportunities for us in this area. Higher power prices, as well as increasing confidence in the value of flexibility, are making gas plants more attractive. And some have begun new projects on that basis. The capacity market has yet to clear at levels that would incentivize a significant amount of new gas. We continue to be convinced that it will, but are not sure that the changes made so far by the government will be sufficient to do so. Investing in gas is a priority for us, as we believe Drax has a key role to play in providing lower carbon generation and system support in the UK. This is very much consistent with our purpose. We also believe that we can earn sustainable and attractive returns for shareholders in this area. The second area is biomass. The conversion of Unit 4 is an excellent project for us and for the system, as we will now be able to support the system when it needs it the most, and importantly, support it with renewable generation. In addition, we are working hard to reduce the cost of biomass generation. This is focused on reducing the cost of our own pellet production in the first instance, because as you know, we procure most of our pellets from third parties with contracts that tend to increase in cost over time. Now, while we still have a lot of work to do, and there are many variables outside of our control, fundamentally, I do believe that we have every opportunity to make biomass economic without subsidy. And I'll talk more about that in a minute. We will also go into these topics in quite a bit more detail at our Capital Markets Day at the power station in the autumn. I'd also like to say a quick word about carbon capture. So we have renewed our interest in that area. We believe it will be a key part of a solution to climate change. That being said, several things have changed that make us more optimistic that there may be a route through to doing so in a viable way. First, the government has reinvigorated its efforts and has called for the UK to achieve carbon neutrality and has made funding available to see how CCS can help contribute to that. They have also sponsored work to define the infrastructure, business, and regulatory model to enable that. We are closely involved in that process, which we find promising. Secondly, new technology is becoming available that may make carbon capture more affordable. We're trialing several of those technologies at the power station now, and while the work is early, it's again promising. And finally, there is increasing talk not only of storing carbon, but using it. And ultimately, that could make the model for carbon capture significantly more interesting. And we are looking at opportunities in those areas as well. Many of our strategic initiatives, as you know, are geared towards enabling a coal-free future, and they are progressing well. The Unit 4 conversion is on track, and we expect it to return to service as a biomass unit later this summer. We continue to progress the options to build 4 open cycles, and will again enter 2 of those in the capacity auctions early next year. Our coal to gas repowering project has had its planning application accepted by the Planning Inspectorate, and if all goes to plan, we would be ready to begin building in late 2019. Finally, we are investing small amounts of capital, about £400,000, in carbon capture, as well as working with the government to support their efforts in that area. Just a quick word to reiterate the case for the 4th unit conversion. The capital cost is relatively low. It will cost us about $30 million to convert the unit. And this is because we are reusing a significant portion of our co-firing infrastructure. We are not going to receive a significant number of additional rocks, about 125,000, for the additional generation associated with Unit 4. Instead, we can now spread all of our rocks across 3 units, and whereas in the past, the rocks were unit specific. So overall, this means that generation will only be marginally higher than it was with 3 biomass units, but we should be able to achieve higher prices by operating 3 units when the system needs us most, as opposed to 2 units all the time. By way of illustration, you can see from the chart that peak winter prices are substantially higher than those in the summer. And to the extent that we're now running more in the winter, as opposed to on average across the year, we again should be able to achieve higher prices. Finally, having 3 units available for rocks also helps us manage our supply chain and effectively provides insurance against unplanned outages. Let me provide a little bit more color on how we think we can reduce the cost of our own wood pellets. There's 4 areas that we're exploring. The first major one is reducing the cost of feedstock by using more residues and also over time expanding our fuel envelope to things that go beyond wood pellets. Now, Hunt Forest Products is a good example of how we're using more residues, and I'll talk that through in a minute. The second area is improving our logistics and overall processes. And the LaSalle rail spur investment, again, is a good example I'm going to discuss shortly. The third area is improving plant performance, either performance at the power station. And we are signing an agreement with Siemens to upgrade our turbines. And this will increase their efficiency, effectively reducing the cost of biomass-generated power. And finally, we'll be looking at using technology. So we're exploring ways that we might be able to increase the yield of our feedstock, effectively using technology. Let me tell you how the Hunt Forest Product deal works. So they wanted to build more sawmills in the US. They make most of their money from selling lumber, the finished product, but residues, as in bark, chips, and dry shavings, are also a significant source of value for them. If they have a committed offtake, it clearly helps them with the economics of building a new plant. So the deal that we've done with them is effectively to sell them some land adjacent to our biomass pellet plant in LaSalle. That's not a significant part of the economics here. But more importantly, we have a long-term offtake agreement with them for the residues, again, at quite attractive prices, given the long-term nature of the contract, but also given the fact that there's no transport cost, i.e. the pellets or the residues are effectively adjacent to our plant. And this allows us to change the way that we make pellets. And again, this is very much similar to the dry shavings projects that we've discussed before. But anyway, we don't need to use the wood yard. As you can see on the bottom of the chart there, you don't need to use the chipper. And for some of the feedstock, you don't need to use the dryer. That takes obviously significant steps in the process out of the way, and as a result, cost, but also not to mention that the actual material is quite good value anyway. This also, though, offers us the opportunity to increase our capacity at relatively low cost. So effectively, if we build a truck dump and some silos and then add pelleting capacity, we can increase the capacity of LaSalle at, again, significantly lower cost than what it would have cost to build initially. And we'll be looking at doing more of these. We think we can probably do this also at our other 2 plants. Secondly, let me tell you about the LaSalle rail spur. And again, this is not a complicated investment. We currently truck our pellets from LaSalle to Baton Rouge. By building the rail spur, we can access the intercity rail infrastructure, which on a per ton basis, significantly lower cost than trucking. We're investing about $15 million. Project should be operational next year, and it should save us more than $10 a ton. So given we'll be shipping 500,000 tons a year or more from LaSalle as we grow, the payback is quite quick, and the returns are very attractive. Before concluding, I wanted to remind everyone of our ambitions for 2025. We believe we can increase our EBITDA to $425 million in 2025. And we have many different projects underway to help us achieve that. So first, the growth in our pellet business and the associated reduction in the cost of those pellets. If we can reduce our cost to a point where biomass is viable without subsidy, that will have a significant impact on that 425, not only in 2025, but beyond. Secondly, the growth in our B2B energy supply business. Third, our open cycle projects. And again, fourth, the repowering. And our increasing competence in being able to deliver those earnings are fundamentally supporting our board's decision to announce a £56 million dividend for 2018. So in summary, we are making a lot of progress as a group. Our pellet business is producing well, and costs are decreasing. Our B2B energy supply business is also growing nicely. Our generation business, while it had a difficult first quarter, is well set up for the full year. And our new projects are coming along well. So while EBITDA was lower in the first half of the year than it was last year, our expectations for the full year remain unchanged. And with that, I'll turn it to questions. So if you direct the questions to me, let me know who you are. I will then either answer them myself or turn them to someone else. Mark?
Hello, Mark Freshney from Credit Suisse. Two questions. Firstly, on the biomass costs, the baseline that they're at now, you allude to them being 12% lower in the presentation. Is that 12% lower versus the £8.10 per gigajoule real? Just to get an idea of where the baseline is. And secondly, on the capacity auction, you're very much dependent upon a decent clearing price. You've got players sanctioning assets, taking FID on assets without a capacity payment. The lower equipment prices are available to many players across the market. What gives you confidence that it's going to clear above £8.40 per kilowatt year this year?
Okay. So on the first one, the baseline, I think the £8 for 15 per gigajoule is probably more of an average, right? I would say the cost base at DBI is probably, I mean, that average converts roughly to that £75 is roughly to 150. It's broadly in line, maybe the DBI cost base is a little bit higher. Secondly, on the capacity auction, I guess probably worth exploring that a bit more. So the government sort of came out announcing last week a couple of things, right? So we've been talking a lot about the need to look carefully at interconnectors and what the derating was for those. So they did sort of, I guess the right way to say it, increase the derating for a couple of them, Netherlands and Belgium. Didn't do the same on France. That actually we were a little bit surprised at that. So we think there's more that they could have done there if they had so chosen to do. And the other thing they did is they significantly decreased the amount of capacity that they would expect to procure. So as I said in my remarks, I'm not sure that actually is necessarily going to get us to a level that we need to have for next year. We'll have to wait and see. But more fundamental, and to be honest, clearly there's the multiple objectives the government's got there. I mean, they want to get the capacity at the lowest cost, which is clearly an important objective. But they also, we think there's a need for new build as well, right? So fundamentally, I guess my view still remains that over the long term, the capacity market will need to clear at a higher price if it's going to incentivize significant amounts of new gas.
Thank you.
Chris?
Thank you. Chris Labour, JP Morgan. Just two questions, please. First, just in terms of will your expectations for full year are unchanged. Could you give us a sense of your comfort around the current level, at least in Bloomberg consensus of 250 million EBITDA? And then secondly, just maybe expanding on the capacity market conversation, just in terms of your view on how you feel the SSE deal recently announced does impact the economics and the dynamics of that market. And how has your marginal cost moved recently? And do you think your marginal cost in terms of the level you need that capacity market to be at, is that coming down?
Yeah, okay. So in terms of the full year expectations, I mean, I think that sort of the Bloomberg would be not a bad reference, right? Fine. I think also if one thinks about 2019, I think the numbers have probably already captured a lot of the sort of benefits that would have come from higher power prices, but that's probably already in there as well. Right? In terms of the capacity market, what's the impact of the SSE deal on the market? I think I don't know the answer to that. I mean, fundamentally, I think that's a question for how the government will set the capacity that they require. Right? I think that maybe the important thing I could say there is I don't think we are at this point to a point where we would say we'd go ahead and build without a contract. Right? I think we still think it's important that we have that contract to underpin the economics, and that's probably what I would say there.
Hi, Lakis Athanasiou, Agency Partners. Two questions, please. One on pellet production. I may be missing something, but I don't get why this is attractive. I see your revenues this half year, you're talking about £8 a gigajoule FOB, the Gulf. Getting it into Drax is going to be considerably higher than that. The full year last year was a lot higher. and you're close to full production now. So I can't see why you'd want more pellet plants, because they seem to be completely out of the money versus your average costs. There seems to be significant cost subsidization from Drax. The second question is IT systems in Haven. Can you expand a little bit about what's left to do and which bits are left to do which are customer facing? Because this is an area which I think gives all of us a lot of concern, because it doesn't seem to be any successful rollout of new IT, customer relations and billing systems. And forget about mass markets. I think in the business systems, when Centrica tried to do theirs, they became a complete cropper. Recently, United Utilities and Severn Trent Water on business, just absolute mayhem there. So can you talk a little bit about that, please?
Yeah. So I'll take the one on the pellets, and then I'll ask JK to take the one on the systems. Yeah. There are lots of things that we are doing to drive the cost of our pellets down. Right? That ranges from, moving our headquarters from Atlanta to Monroe. Those benefits have not come through. It includes bringing in more dry shavings. Those benefits have not come through. It includes building things like the rails where those benefits have not come through. And I'm very confident that both the returns and the level of ultimately the sort of absolute level of those pellets will be significantly lower than what the average cost is. We need to prove that to you. Fair question, but I expect that we will. Right? On the IT systems, I think the broad question, I think maybe a broad answer in terms of the way we think about that philosophically is, no question it is a major project that we have to make sure we manage very carefully. Right? And that's sort of the way I think about that is it means making sure you do things in small pieces, and then make sure that you don't end up with sort of massive risk by having to do. And we're small relative to these guys. Doesn't mean it's any specifically less complex, but it's also smaller in scale. So maybe I'll ask JK to give you some more detail.
Yeah, and I think there's a consideration at the point of going into any one of these complex build activities. Sort of two areas where real challenge appears is mass legacy. So people like some of these big sort of, I suppose, public disasters have come off the back of real complexity in old billing systems and multiple billing systems. And then the second thing is about migration of mass customers to one new system. And the reason why you get this one new system is because digitization drives a need for common processes. And so everything has to converge on one system. So one of the things we did, and we were quite clear with this, is to make sure that you buy the system that you bought and you don't over-customize. So to give you an indication, most IT implementations take 500, 1,000 customizations to meet your own processes. And ours is about 35. So we have ensured that actually the customizations we're making are very small, and we are changing our processes to meet that. And then the final point is about how you get your people basically to get ready for the change. So as Will said, we're implementing over a slow, long period. We implemented the first release of our software earlier this year, which was the finance and procurement system in Haven. We're now into our third month end, and we feel very confident that that's gone in successfully. Our people are very engaged in that, and they've been part of the process. And we now step forward into the billing system itself, which we'll expect to see later this year. And again, we will bring customers over onto that in a very controlled manner. And as we build confidence in that, both our people and our customers, we will then start to increase the migration in a very controlled methodology in order to bring that across well. So, we believe we put all the conditions we feel are there for success, but clearly we remain very focused on that activity.
Is that a new system that you migrate both Haven and Opus customers on, or mostly just Haven?
So we will start with Haven. Clearly, again, down to, as Will said, our controlled approach. We have a lot of optionality here. We have two good billing systems that we can hold for a while. And so essentially we will have to move Opus to get the full efficiency that we're looking for. But again, we'll work carefully as we progress through this, and obviously make any adjustments to our timeframes based on what we see with the Haven migration.
James, yeah.
James Brown from Deutsche Bank. Two questions. First is on the biomass cost target for over 30% savings. Obviously, one important ingredient in that is the pound-dollar exchange rate, at least at the moment, given that a lot of your costs are in dollars. I was wondering how that factored into that number. So is that number a sterling cost reduction at current exchange rates? Because if so, it would seem to imply more like 50% or approaching 50% savings in dollars. So I was just wondering whether you could put that in context of the exchange rate. And secondly, a question on system support and flexibility. Obviously, that number had gone down year on year, and you explained it was down to the black start, and have been optimistic that over, as you say, the long term that income could grow. But what's the outlook for that over the next few years? Should we expect that to be growing with a shorter term view? Thanks.
Yeah, okay. So on the the pound dollar situation, I mean, clearly we need to get, ultimately what matters is the pound number, right? I mean, currently, if we look out to where we're hedging currently, probably about 1.4 if you include the forward points, right? So it does make it a bit more challenging. Now, that being said, the value of our contracts also grows with inflation, so there's a bit of an offset there, right? So, but anyway, we have to make sure we get there in pound terms, right? And I'm first to acknowledge there are lots of factors in this, which we're talking about 9 years from now. We don't know where power prices are going to be. We don't know where FX rates are going to be. So I'm not by any means promising here, right? But the intent to get the cost down as much as we can is obviously key for us, right? In terms of where we see the market for system support, I mean, there's a couple of points here. One is, we do see it, we expect it to continue growing as the system becomes more intermittent, and we think that should start to happen, right? It's very difficult, though, to plot that sort of it's not going to be linear, right? So, for example, there hasn't been a lot of wind, right, in the last few months. And if they're having a lot of wind in the summer, it does offer opportunities to support the system in different ways, right? So it will bounce around, right? And the other thing, I think there is a bit of this which is not necessarily that easy to measure, right? Because not only are we sort of seeing this value through specific ancillary services, but we might see it in the balancing market or even in the day ahead. And so some of it, there's some measurement issues there, right? But we're again quite confident it will grow.
Thanks. It's Ian Turner from Exane. As a point of clarification, you were talking on the slide about the development of options that you could start to build something in late 2019 if the capacity market went well. Was that the OCGTs or the coal to gas?
So the OCGTs, we've got 2 of them that we were put in the auction, have already put in, and we would put them into the auction in the next one's coming up, well, this coming February. That the coal to gas is the one I'm talking about for late 19, which again, the auction may be late 19 or early 20. That's the one specific reference there.
So let me ask that question again. So the coal to gas isn't pre-qualified because it doesn't have planning permission
Correct.
yet. So how could you start building it in late 19? Because you couldn't.
The plan is to have the planning permission by late 19 and then get the contract and then start to build. Yeah. I mean, it's quite a tight timetable, but that is what we're hoping to do. Dominic?
Hi, yes, it's Dominic Nash from Macquarie. A couple of questions, please. Firstly, actually both on sort of carbon, kind of. The first one is on the CPS, the UK CPS. Obviously, with the rapidly rising European carbon price, the CPS is kind of now going back in line with the original profile. Have you been having any conversations with the government about what's going to happen to the CPS when it comes to the end of its current sort of legislative timeframe? I think it's end of 2021 now, I think. And secondly, following this into the CCS, are you trying to resurrect the sort of White Rose project again? And the second is you've piqued my interest here. You say that you can use carbon. How we can use carbon?
Okay, so let me just take sort of those 3 questions there. So I think the carbon price support sort of through 2020, I think, is pretty much set. And the government has also said that a firm sort of carbon price through 2025 is what they're looking for. Now, what that will be, I don't think is known, and I don't have any more. Maybe Gus has better information. I don't have any better information, Dominic, than you do on that, right? I mean, clearly, I think that a good carbon price is important for decarbonization in the UK, and the current government, I think, is quite committed to decarbonization. So the question is, how they will use the various different levers available to them, as obviously that's their call, obviously. So second question was around, I guess, White Rose. Are we trying to resurrect White Rose? I think that's not the way I would put it. I think it's very much, I think it's important to think of this as the first stages of something that could be potentially interesting and has to be economically viable, right? So the first key thing we're doing is trying to understand whether the solvents that we have, that people have developed to actually capture the carbon out of the flue gas, do so in a way that is both, frankly, less toxic, but also less costly than what it would have cost before. And if you I think about this as a sort of 3 or 4 stage process. One is capture, then the second one is transport. So you need to get the carbon somewhere. That's going to be a big infrastructure project. And the government task force that is looking at this is actually coming up with ways, and they've sort of already said they may look at a RAB-based approach to that. And then the third question is, what do you do with it, right? Which gets to the last point. So the interesting ways you can use carbon, if we could get our CO2 to be food grade, maybe we could help solve the shortage of CO2 for the beer industry, right? For example. Frankly, that's not a big number. Right? It's a small number. I think, more relevant. I mean, there is a market in building materials, possibly. They're much more sort of further out and technically complicated, but much more interesting is, could you actually use green CO2 as a way of combining with hydrogen or other chemicals to make green fuels? Right? Now, again, this is way out there, but that's actually something we are starting to look at with partners. And I should say, Dominic, I mean, we are obviously a small player in that game, but there are some of the big oil companies have done a lot of work in this area, and there's actually quite a bit happening there.
So that would be like plankton and stuff like that?
No. That is much more simple. So you take methane, you get the hydrogen out of that in a green way, I mean, using carbon capture. Take that hydrogen, combine it with our CO2, call that green CO2, and you end up with various different types of, whether petrol, jet fuel, those types of things. But further out there, just make sure that's clear.
Mark Freshney from Credit Suisse. Just two detailed finance questions. Firstly, on the bad debts, which I believe mostly relate to Opus, can you give us an idea of the magnitude? Because it's a low margin business and you need 1 or 2 big invoices not paid and it can make a material impact. So if you've got sort of like the year-on-year movement in bad debts. And secondly, just on the invoice discounting, what is the total magnitude of invoices outstanding that you've taken off balance sheet at half year?
So Dan, can I ask you to take those? Or
yeah, sure. I mean, on the you're referring to the B2B energy supply facility that we have. The facility is 150 million, and we had drawn 140 million. At the year end, we'd drawn 110 million. There's been a 30 million increase. On the bad debts, there's been a 9 million increase, half year on half year.
And that's across both Haven and Opus?
Yeah, just across both. Yeah, across both.
Are the bad debts split? Is it 1 or 2 big invoices or 1 customer, or is it split across the customer base?
So let me just take sort of bad debt as a whole piece. There's sort of 2 aspects going on there. And so we see obviously the whole retail business as we're talking across it. I mean, what we're seeing, as Will said, is that there is a deterioration in the market. So there is a lot of, through the sort of, I suppose, digitization of retail, there are a lot of difficult market conditions for businesses in that area. And we've certainly made some quite important adjustments and prudence to the approach that we have to those markets, but clearly we have a base of those customers as well. One of the things that we've done this year is, and through some of the successes we had with Haven, was through really tight management of debt. So we were able to take a sort of unprofitable retail businesses into profit over time. And one of the key sort of activities was around managing debt more effectively. And really, it's not about the sort of, I suppose, the big number. It's about small numbers in debt, where you're looking at customers that have moved from paying their bill to not paying their bill in 30 days, or then 60 days, or then 90 days. And what Opus did is it took a very average provision across customers that haven't paid after 3 months or customers who haven't paid beyond that. And so what we wanted to do is implement the same level of rigor and the same level of strategies that we have done within Haven. And in doing that, you have to build up the balance sheet to obviously deal with each of those components. And when I come back to the strategies, a good indication is a customer within 30 days, you probably talk about a payment plan. And you know, you work with the customer to return those monies. Whereas customers who haven't paid after 90 days, we tend to use third parties because they are much more effective at collecting that debt. So I see this very much as we've strengthened the balance sheet. We're in a good position now, and we feel very confident that we can manage these two profitable businesses well.
And just to be clear, the 9 million is actually the charge. It's not the increase in provision.
Yes, it's the charge.
Any other questions? Maybe just one thing on Dominic, on your question. I just want to be clear on this whole carbon capture story because it's very early. We're not spending a lot of money. We've spent £400,000 so far. And ultimately, for it to work for us, it has to be something that works for our shareholders and we can get a reasonable return. So, you know, I think it is exciting. I think it will be part of the solution, but how we get from sort of A to B, there's still quite a lot of work to do to get there. Okay, thanks very much, guys. Yeah.